Hey there, this is Jacob Wood with Coldwell Banker Warburg with your Q1 2026 Manhattan and market update with data from Urban Digs. Now, the second half of last year saw promising momentum with a dramatic uptick in luxury market activity in Q3 and a bonafide market rebound across all price points in the co-op market in Q4. Early signs showed that momentum continuing in Q1, and by several metrics it did so. Sales activity, the number of trades per quarter, and total sales volume both rose year over last quarter for their best Q1 performance in 4 years. Median sales price increased 8% in Q1, although that was largely the result of luxury market activity rather than bona fide appreciation across all price points. I mean, it's not as if your home that was worth $1 million a year ago is worth 8% more than that now, but rather that there was a 10% increase in sales activity above $3 million in Q1. A more accurate depiction of market-wide appreciation would be the 2% year-over increase in average closing price per square foot that we saw last quarter. Now, we know that when we see an increase in activity but not pricing, that means buyers are present and active but intolerant of overpricing. I mean, this is not the 2013 market where if you overpriced your home, the market would catch up to your ask. And we haven't really seen a market like that since. But if your home is well priced and well marketed, buyers are jumping on it. We see that especially borne out in last quarter's average days on market figure of 79, the fastest Q1 pace in 8 years. So why are we seeing an increase in pricing? The answer lies in a lack of buyer and seller confidence around the war in Iran. Oil supply chain disruptions cause prices to increase across the economy. Bond investors demand higher yields to account for the inflation, thereby raising interest rates, which currently sit just above 6.25. Now, we recall that's where rates were in 06, 07 when the market was gangbusters, so we can have a healthy, sustainable market with rates as they are. Problem is, day before the Iran war started, rates were in the 5s, and buyers are understandably hesitant to tie themselves to a long-term commitment when for all we know the interest rate environment is peaking. The solution I've been advising to this is for buyers to seriously consider adjustable rate products, which currently have options in the 5s. Now, if you're a 3 or 4 bed buyer, you're looking to stay in the home for 20 years, it may not be an ideal fit for you unless you're comfortable paying off the loan in 10. But if you're a 1 bed buyer with average occupancy of between 5 and 7 years, you have the opportunity to buy into an easier market at preferential rates. And of course, if you're a cash buyer, this is when you want to do business relative to a lower rate environment. So if you're interested in how the market for homes like yours is currently performing, or you'd like more info on what kind of negotiability you can expect for the particular home you're interested in, let's talk more. This is Jacob Wood from Warburg.